afternoon, distinguished ladies and gentlemen. The Monetary Policy Committee met on July the 21st and 22nd, 2014, against the backdrop of continuing quantitative easing, tapering by the U.S. Federal Reserve, which has resulted in the slowing of inflows to emerging markets and frontier economies, and the attendant uncertainties in the world in the outlook for monetary policy and financial stability in the post-tapering period. The meeting was attended by 10 members. The new member, Professor Dahiru Hassan Balami, whose appointment had recently been confirmed by the Senate, was also in attendance. The committee deliberated on key external and domestic economic developments and considered the banking stability report since the MPC meeting of May 2014, as well as the outlook for the rest of the year. The global monetary policy environment appears to be further complicated by risks posed by continued currency crisis and fragility in Europe, geopolitical tensions in the Middle East, and a number of emerging and developing economies. Domestically, the policy changes remain. This includes the uptick in inflation, anticipated increased spending towards the general elections, and the possible effects of U.S. tapering on the domestic market. International economic developments. The committee noted that the rebound in global economic activity strengthened in the first half of 2014, although at levels lower than previously projected. The tapered growth arose mainly from the emerging and developing economies owing to the rising real interest rates and geopolitical crisis. On the whole, the effects of the global financial crisis have continued to wane, even as the issues of rising income inequality, unemployment, and poverty appear to be gaining prominence, engaging the attention of the monetary authorities. The latest projections indicate that the euro area is gradually coming out of recession, as growth projection for 2014 is positive for all member countries, albeit with significant variation. Growth is expected to be stronger in the core EU countries, while high debt and financial fragmentation continue to weigh on aggregate domestic demand in the peripheral countries. For the entire Eurozone, there is a risk of low inflation or outright deflation, which could result in higher real interest rates that may constrain output expansion. In the emerging and developing countries, growth is expected at 5% in 2014 from 4.7% in 2013, buoyed by stronger external demand from the advanced countries. The key downside risks in the developing and emerging economies include political uncertainty, exchange rate realignment in response to changing fundamentals, further monetary tightening to address emerging currency crisis, and tighter external financing conditions arising from the rapid normalization of U.S. monetary policy. Inflation is projected to remain subdued in 2014 and 2015, partly reflecting the significant output gaps in the developed economies, weaker domestic demand in developing and emerging economies, and sliding commodity prices, especially fuels and food. In the advanced economies, inflation is currently below target, and its return to the long-run trend could take a while due to the slow pace of economic recovery. Likely depreciation in currencies, domestic demand pressure, and capacity constraints could pose upside risks to inflation in the emerging market economies. The committee noted that the stance of monetary policy could diverge across regions over the medium term on account of variations in risks and other challenges confronting various economies. The US is expected to commence tightening by the second half of 2015 as inflation hits the long-run target and unemployment rate falls to the threshold level. The euro area and Japan are expected to continue with supportive monetary policy due to low inflation, including threat of deflation in some countries. Weak recovery, weakness in bank balance sheets, and strong demand for their bonds as a result of low sovereign risks. Majority of the central banks remained cautious with regard to the stance of monetary policy. While most advanced economies are likely to maintain an accommodative stance for monetary policy for the rest of the year to firm up aggregate demand and employment, the major impetus for monetary policy adjustments in the emerging markets and developing economies could come from the effects of the U.S. Fed's tapering of QE3 on their currency and the financial markets. The domestic economic and financial development. The National Bureau of Statistics reported revised growth numbers from 2010 to 2013 and the first quarter of 2014 as part of the GDP rebasing exercise. Accordingly, the now 5 and 4.21% recorded in 2011 and 12 respectively. Similarly, the revised estimate of 6.77% for the fourth quarter of 2013 was an improvement over the 5.17 and 3.64% in the previous quarter and the corresponding period of 2012, respectively. In the first quarter of 2014, real GDP growth was 6.21%, which was higher than the corresponding quarter of 2013. In line with the trend, the non-oil sector was the main driver of growth in the first quarter of 2014, recording 8.21% growth. The key growth drivers in the non-oil sector in the first quarter of 2014 remained industry, agriculture, trade, and services, which contributed 1.77, 1.26, 1.26, and 3.15% respectively. The oil sector continued to record improvements in performance, with its growth rate improving from minus 9.36% and minus 11.40% respectively in the fourth and first quarters of 2013 to minus 6.60% in the first quarter of 2014. The committee welcomed the impressive growth performance but noted that the country has the potential to do better with appropriate supportive macroeconomic policies. The committee therefore stressed the imperatives for monetary policy to sustain efforts aimed at supporting non-inflationary growth in key sectors of the economy. The committee also emphasized the need for governments to sustain and deepen tax revenues and enhance efforts aimed at fast-tracking the structural transformation of the economy with a view to making it resilient to adverse shocks, as well as creating the necessary platforms for reducing unemployment, income inequality, and poverty in the country. Developments in the aggregate price level suggest an underlying inflationary pressure since January 2014. The year-on-year headline inflation steadily inched up marginally from 7.9% in April to 8.8% in May 2014 and further to 8.2% in June. The uptick in June was, however, largely attributed to the rise in food inflation, which rose from 9.7% in May 2014 to 9.8% in June, while core inflation, on the other hand, rose from 7.7% in May 2014 to 8.1% in June. The committee noted that all measures of inflation have witnessed progressive upward trend since February 2014 and agreed that this trend should be monitored closely to achieve a reversal. Monetary, credit, and financial markets development. Broad money M2 rose by 1.66% in June 2014 over the level at end of December 2013, indicating an annualized growth rate of 3.31%. The annualized growth rate was considerably lower than the growth benchmark of 15.52% for fiscal fiscal year 2014. For the same period, net domestic credit increased by 0.88% compared with the growth rate of 15.39% over the corresponding period of 2014. While when annualized, net domestic credit rose by 1.77% compared with growth benchmark of 28.5% for fiscal 2014. The expansion in aggregate domestic credit was mainly due to the increase in claims on the private sector, which increased by 2.75% in June 2014, which was however moderated by the contraction in net credit to the government. Meanwhile, money market rates remained within the MPR corridor during the review period. The monthly weighted average open buyback rate was 10.38% in May 2014, but increased by 14 basis points to 10.52% in June. The uncollateralized overnight rate was 10.5% in June 2014, compared with 10.63% in May of 2014. Overall, both the OBB and overnight call rates were trading closer to the lower bound of MPR corridor on account of liquidity surfeit in the banking system. Activities in the capital market were bullish during the period, with the all-share index increasing by 2.8% from 41,329.19 at the end of December 2013 to 42,482.48 at the end of June of 2014. Market capitalization also moved in the same direction. External sector development. All the segments of the foreign exchange market witnessed a considerable degree of stability during the period. The exchange rate at the retail Dutch auction system of the market was flat at $157.29 naira to the dollar in the review period. At the interbank market, the selling rate opened at 162.2 to the dollar and closed at 162.95 to the dollar, representing a depreciation of 0.75 naira or 0.46%. Conversely, at the BDC segment, the exchange rate opened at 167 naira to the dollar and closed at 168 naira to the dollar, representing a depreciation of 1 naira or 0.6%. Gross official reserves rose to $40.2 billion by the 18th of July from $37.31 billion at the end of June of 2014. The increase in reserves was mainly due to increased accretion and moderation in the rate of depletion. The committee's consideration. The committee was satisfied with the relative stability in the macroeconomy as reflected in the impressive growth rates, stable consumer prices, and exchange rate, as well as increased external reserves. It was, however, concerned about translation of stability to microeconomic gains in employment and access to finance, especially by small and medium-scale businesses. It therefore emphasized the need for the Monetary Policy Committee decisions to take into account the long-run impact on employment level, wealth creation, and growth of businesses. The committee noted the potential of the power sector to stimulate output growth through enhanced investment and the spillover effect in employment generation if the challenges confronting the sector are effectively and appropriately addressed. Specifically, it noted that gas to power has remained a binding constraint in reaping the benefits of the recently concluded power sector reforms, urging for the collective efforts of government, private investors, and the banks to resolve. Other pressure points include the underlying pressure from food and core inflation and the risks that could emanate from the likely increase in aggregate spending in the run-up to the 2015 general election. The committee was also concerned about the implications of the ongoing QE3 tapering for inflows and external reserves. The committee recognized the necessity of sustaining a stable exchange rate, even as it has to deal with the delicate balance of the need for a low interest rate regime. Committee noted that portfolio flows were not employment generating, but were essential in the absence of adequate fiscal buffers. The committee welcomed the moderation in the rate of depletion in the external reserves in recent months, noting that reserves creation needed to improve much faster to provide a strong and more resilient buffer to fiscal operations. Committee, however, noted that a gradual reduction in the country's import bills from domestic production of some of the major food imports should be a key element in the overall reserves creation strategy. It welcomed the decision of the bank to collaborate with other stakeholders in this regard. Committee further expressed concern about the liquidity level and the trending uptick in inflation, which may not be unconnected with the poor harvest in some agriculture producing areas, particularly in the northeastern and central states of the country. It, however, noted that other reform measures could dampen food prices in the short to medium term and restore inflation to a sustainable long-run path. Overall, the committee noted that the policy direction of inflation, exchange rate, and interest rate must be seen not only in the context of price and financial stability, but also in enhancing the quality of life of Nigerians and promoting employment generation. The committee's decision. In view of this development, committee decided by a unanimous vote to retain the current stance of monetary policy, with one member voting for an asymmetric corridor around the MPR. Consequently, the Monetary Policy Committee voted to 1. Retain the monetary policy rate at 12% with a corridor of plus or minus 200 basis points around the midpoint. 2. Retain the liquidity ratio at 30%. 3. Retain the public sector cash reserve requirement at 75%. And 4. Retain the private sector cash reserve requirement at 15%. I thank you all for listening. Good afternoon.
Ladies and gentlemen, we are in for the question and answer. Please kindly note that we limit the questions to the content of the communique. Just signify and then tell us your name and the organization you represent.
Good afternoon, Mr. Governor. Nancy, the Monitor AIT. When will Nigerians begin to see the benefits of monetary policy? Because watching a clip before the meeting started, some are ignorant of what monetary policy is about. That's one. Then the second one is, in your agenda, just before this monetary policy, the last meeting we had with you, just some days after you resumed as governor, we talked about we'll begin to see a gradual reduction of interest rates. When are we going to see your dovish attitude towards interest rates?
Okay, another question?
Thank you. Over to the governor.
Well, thank you very much, Nancy, for that question. Basically, when we talk about the benefits of monetary policy, part of the core mandate of the Central Bank of Nigeria is to achieve exchange rate stability, ensuring that we are able to build strong reserves for the country. I believe that that objective we are achieving, given that our reserves, like I read in my report, that our reserves now stand at over $40 billion, which supports almost close to about 10 months imports. I also know that, yes, part of the mandate also ensure that we achieve low, as much as possible, interest rate, as well as a good, inflation, keeping inflation at a level that makes life easy and good for our people. We are working on the issue of the interest rates. Yes, it is a statement that I made when I made my statement on June the 5th. And what I said at that session was that we are going to pursue a gradual reduction in interest rate. That agenda is a 5-year agenda statement that we made. We are monitoring the situation, but like I said also during that press briefing, we are going to continue to monitor the situation, monitor the liquidity situation in the market, monitor spending of Nigerians and government in the run-up towards the election. And as we begin to see that the macroeconomic variables are moving in the direction that we expect, you begin to see the reversal interest rate in the direction of going low. We are optimistic of the mandate and the promise that we made to our people to bring down interest rate, but I'd like to please crave your indulgence that we will continue to look at all the variables. We will do everything that is possible to ensure that this is achieved, but it has to be within the ambit of monitoring all the parameters to ensure that we do not achieve that and create another problem in another direction. Thank you very much, Nancy.
Mr. Godwin, my name is Communique.
Tell again. I
write for the Wall Street Journal. After the rebasing of Nigerian economy in May 2014, I want to know whether or not you are seeing a change as a result of inflow into Nigeria's stock, bond, on the naira. Thank you.
Thank you very much, Benga. Yeah, of course, naturally, because as a result of, even before the rebasing, Nigeria remained one of the largest economies in the world. An economy in Africa where people feel, yes, the opportunities, investment opportunities abound. An economy where people are convinced that the yield on their investment are very good compared to in different parts of the world. Yes, it is true, we started seeing some inflows. There was a slight reduction between February and May, but between then and now, we started to see some uptick, and I would believe that the trend will continue, particularly as people begin to embrace the government's policy on the privatization of the power sector, or on the reform that is going on in the power sector as well as in the oil and gas sector. And the Central Bank of Nigeria will also work with all stakeholders to ensure that some of the benefits that we expect to achieve are achieved in this direction. Thank you.
Okay, I think that wraps it up. I would want to appeal that as we retire, we please keep calm so that we can listen to the feedback from the markets on CNBC, so we can listen to it and get some more enlightenment on this. Thank you.